Rob's Child. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to open its content for discussion. This is Chapter 50, Discrepancies Between Price and Value. This is one of the most cited, I think, chapters of this book. There's just a bunch of big takeaways from it. One of the things I wanted to mention before going through the points of this chapter is how you have Warren Buffett oftentimes talking in many of his shareholder meetings. If you're this deep watching this video, I'm sure you've probably seen them, with Warren Buffett talking about how, since this book has been written, basically there's been less and less amazing opportunities for these types of obvious investment opportunities. But I think he says that I think there's more room for finding these kinds of investments than he believes. Again, one of the things with him is he sticks to investments that he understands, businesses that he understands. He doesn't bother with even looking into a heck of a lot of industries just because he doesn't understand them and is not interested in them in that way. And so, and then one of the biggest things I think coming from this chapter in particular is just reiterating for the umpteenth time how markets are emotional and they're not logical or mechanical. So let's go through the chapter. So first point, prices are frequently illogical and erroneous. Again, there are arguments to be made today that maybe less so today because of efficiency of markets. The fact that you have literally artificial intelligence using data to determine buys and sells of things is, going to continue probably, I assume, to get harder to find advantages in these areas. But again, I believe that there is still room to find things of these kinds of opportunities. But moving on, again, like he's saying here, markets are psychological, not automatic or mechanical. And yes, and obviously today, and this is obvious even in the treasury markets, pricing in, where the smartest money supposedly is. Think about Bank of America, for example. Many banks loading up on treasury bonds when they were the cheapest they had ever been in history, and then subsequently had lost tons of value. As of today, I think the 30-year bond is at 4.5%, something around there. And there's definitely emotion involved, and anyway, let's just keep going through this chapter. All right. So next point regarding this is that he says that I like is mistakes are made in groups and by the masses. And obviously, the smaller the company is that you're looking at, the more room there is for a group to overvalue or undervalue something versus something bigger and more popular. And he talks about that later in the chapter. But so 3 causes of the mistakes are exaggeration of price, oversimplification of what's going on, or neglect. Those are the 3 reasons that something can kind of get lost in its valuation. And I found that to be interesting, especially, you could even say Bitcoin before 2020 was suffering from quite a lot of neglect. You had the miners trading, 70 cents on the currently $20 mark, still today. That might be a neglect situation, or, any industry that's been under the radar for long enough, those I think present pretty cool opportunities. In particular, pipelines, dry bulk shipping, and Bitcoin miners before they really took off. It's 3 examples of my own. And then he mentions that this chapter and the next chapter, this is sort of a 2-part chapter, but he's attempting here to concisely review various aberrations in the markets and how an analyst can profit from those. So then we go through 2 categories of methods that can be used. The first being deviations within an industry, and that was like the entire last chapter. And then the second one is, he says, take a quick glance at about 100 reports, and that might reveal to you 5 to 10 that are interesting regarding earnings or from a current assets standpoint. Again, I think that Warren Buffett says, and I don't know how true it is or not true, that finding things these days is very difficult compared to how things used to be. And again, it seems like it's going to be continuing to get even more difficult moving forward into the future with artificial intelligence and so many people being so much more educated in this area and securities analysis in general. I mean, look at me. I'm trained as a trumpet player and been doing this for 5 years now, studying and learning about securities and security analysis. So, so anyway, yeah, let's move on. Next subtitle: Can cyclical swings of prices be exploited? I think he essentially says no, sort of, but he has some points here that have been mentioned. Most of these points have been mentioned in the book before, but specifically on page 686, he has rules that essentially suggest averaging an earnings value 7 to 10 years, or like I said in the previous chapter, it's supposed to cover basically the full cycle of a boom and a bust, so you can get a true sense as to where the real average is over, good times and bad times. And then I think what I'm getting out of how he wrote it, the easiest way I'm calculating this is to buy basically when PE is at least a third discount, so like 33% discount to the average of a boom bust cycle, and then selling when it's a third higher than the average of a boom bust cycle. And then he also says there, though, basically depending on how much beta the company has. So if you have something that has a swing that's greater than normal, he talks about starting at a 20% discount, I assume, for something that has a little bit lower beta, and on a scale basis going from that point, and then selling equally from between, specifically he says 20% and 50% of premium, if you can get that. So based on those rules, I think he said those rules were written by somebody as like general advice, and he says that if you had followed those rules, you would have basically sold out right before the great boom of 1926 to 1929, where things were getting out of hand, too expensive, and then you would have actually lost because the discount went further down from 1931. And so, and he says, a quote here, "It would have made far too heavy a demand on human fortitude." I found that to be really funny. People can't handle those kinds of swings. If those are your rules and you're trying to trade the ups and downs of the markets, and that's what happens, it's like that hurts a little too much. And so, it leads him into the next subtitle that catching the swings on a marginal basis is impractical. We'll get into that. But and then before that, another point he made was how basically what I got out of it was you won't always win, but at least you can buy cheap to intrinsic value. That you can, you won't. I mean, that phrase speaks for itself. So in this section, catching the swings. This is about by actually using margin, and this is what I've heard other people talk about before. Like even like some of the really big traders out there, they're like never trade on margin. It's when you're paying to borrow money and hoping that you're going to beat the market at the same time, you're playing. It's a foolish game to be playing, and he says that basically here buying on margin and shorting are just straight out shorting things are impractical, and it leads to typically temporary bouts of success, and I quote, typically also ending in complete disaster, his words. So stay away from margin, stay away from shorting, generally speaking, is kind of his advice there. My take on shorting or buying naked puts or something like that is just that if you're going to be playing that game, just know know that you can lose, know how much you can lose, and just be highly aware that you are speculating. And it's not, I don't think it'll end in complete disaster as long as you're not going 100%, putting every penny you own and puts on SPY or something like that. Like what is that, Reddit, Wall Street Bets or something, people always putting their life savings in short-term calls on SPY and stuff like that. But moving on. So before we get into the later parts of the chapter, he mentions there's no well-defined standards as to when high-grade bonds are cheap or expensive, or DER corresponding to the earnings ratio test for common stocks. And so there's no well-defined standards, is what he says. And then very interesting point he brings up that I thought was mentioning how the loss of interest that you'd normally be gaining on, say, money market account, for example, between sale and repurchase of a security isn't worth it. So I think, or maybe of the bond that he's talking about there. So the point is if you're trying to swing trade high grade bonds, it's just simply not worth it. And this makes me wonder, like, what he would think of, like, especially the 1970s when interest rates went higher than anyone could have possibly imagined, before that time period. But maybe he wouldn't, maybe he wouldn't blink twice about it. He lived through, obviously, the 1929 crash and everything. And, I think living through really crazy financial times gets some of these, gets people that have lived through these things to not be surprised by things that seem wild and crazy in the future. But anyway, again, like, when you're buying a bond, are you buying it for the coupon payment, or are you buying it hoping that it's going to appreciate in value because interest rates are going to go down? And he would probably he does advise against trying to figure out which way the tide is going, but we'll get there when we get there. So then we have a section on secondary or little known issues, basically, like, I guess, penny stocks or small caps at least. He says they're likely to yield instances of undervaluation at all times. I found that to be interesting. And then basically refers to the fact that they have more beta, more upside and downside. That's pretty easy to understand. And then notes that, the amount of beta that he doesn't say beta, but he refers to beta. The amount of beta that an investor wants in their holdings is up to the investor. And of course, like this can be achieved within industries, especially I find like ETFs, like junior silver miners versus regular silver miners, or small caps versus large caps. That you get that higher beta where a downturn it goes down more, and an upturn it goes up more. And so you know and that's a choice. So right. And then we have another mention of emphasizing basically that stock prices are emotional, again for the umpteenth time at this point. Even a lot of these points in these last few chapters reiterate the very first chapter in the introduction, actually. And then we repeat that quantitative. He illustrates basically a point that states basically that quantitative data is only good with qualitative data. So just because the numbers look perfect, like for a good situation, it's also a business. You can. Are they selling something that no one's going to be buying in the next few years? The qualitative aspects are very important. Obviously, I don't know why he restated some of these points in these last chapters. It seem so obvious at this point that I don't really know why he's restating them so much. Maybe just to really pound it into people's heads to make sure they're really getting it, I guess. All right, and then we have a point that small caps can more easily lose all of their earning power, but obviously also have more potential for growth. And one of the examples I found funny in here was how he pointed out that Pepsi grew more than Coke in whatever period he's referring to. I guess Pepsi was a smaller company, and when the whole industry grows, Pepsi is able to grow more than Coke, despite the fact that it's smaller and probably has a more conservative capital structure, But anyway, moving on. He mentions that we have a point made that diversified bargains is better than just like one or two expensive small caps. So, it's easy to get caught in that, right? Especially with like the Cathie Wood stocks, for example. This is an area where you could get tricked, really. Think about how popular those stocks have gotten. Relative to their industry and, perhaps their competitors that are like not even known about. That's, I think, a good parallel to what's going on today, or what had been and has been going on today, I guess. But anyway, not to say maybe she has picked the perfect winners. Who knows? We'll see. So then, but also he says, so avoid all of this when the general market is statistically much too high. So if everything's too expensive, don't be looking for diversified bargains. And later he goes into detail why that is. It's mostly because issues that are not well known and already undervalued, when the whole market is overvalued and is bound to go down in valuation, those things are not going to do well. They're actually going to become even more undervalued. So, just being aware of how expensive the whole market is an important factor. And like I've said in other videos, beginning of 2024, it is now. The S&P 500 having a PE ratio of 25 is expensive. And so by this idea, for me, by the way I see the market, I think it's expensive. Maybe not everybody does, but I think it's expensive. And so I should not be looking for bargains, because those bargains, according to what I believe, will become even cheaper, will become even more of a bargain in the future. And then we have a very interesting point here. I think this is one of those hidden gems in the book, like many points in this book, where he notes that basically large cap, well-known big stocks react very quickly to news and earnings, and how the price exaggerates changes in earnings like that. But they don't do so in a way that's like over exaggerated. It's over exaggerated, but not as much as what can happen in small caps. So funny enough, small caps have, he says, sort of a double-edged sword in this regard. They can have, it's a two-pronged effect. He says small caps can react very slowly to changes in earnings if they're like, ignored, if nobody notices them. Nobody knows about the stocks and they have like a major change in their earnings prospects. Well, nobody cares because nobody knows about it. There's no interest in it. So that's very interesting. And then the opposite can happen too. All of a sudden, there's this company that has huge earnings, and then they're also on the news, so everybody knows about them. Well, you can kind of see what can happen there, or equally in a collapse of something, maybe, I guess. But then he shows examples, including companies with obvious temporary positive qualitative factors. For example, like warplanes, companies that are making things that are, we're not necessarily going to continue buying these things. A super good earnings report, and that I think that led to actually under exaggerations of price, where but it makes sense using, again, the qualitative factors. And again, so we repeat that when the overall market is dangerously high, be extra careful with bargain stocks, because the bargains will become even more of a bargain when there's a downturn. Like he said in previous chapters, in normal times is when the ideal time to be looking for the big bargains, or in a depressed market, obviously. And he says here basically, in a downturn, unpopular stocks can actually suffer the most. You think you're getting a good deal. Anyway, I think that is a real gem from this book. So then we have a section on other market exaggerations and how they can come from changes of dividend. So when a company announces, "Hey, we're gonna increase our dividend," everybody gets overexcited, he says, and that makes me think there might be a good shorting opportunity. You get that news, immediately short the thing, because it's gonna get over exaggerated and come, normalize very quickly. Sometimes in minutes, but. But anyway, for the dividend changes, he says it's especially like exaggerated when you have stock splits or stock dividends. A stock split's good; it adds liquidity, and so that can it can literally add to the value of the company, the stock, just because it's more liquid. More people can more easily buy and sell the shares. Granted, now we have fractional shares, but that's a whole nother discussion. I think most people try to avoid the fractional shares, because at that point it's just like you don't even feel like you're. I mean, think of it psychologically. You don't even feel like you're a real shareholder if you own like part of a share. Like, what is that? But anyway, the other market exaggeration can be caused by mergers and segregations. And he goes into detail about that, how the stock market often. He says believes that 2 + 2 = 5, and then later it's 3 + 3, and how I think that's in a merger or segregation, I don't know. Then he notes that here that insiders can see trouble ahead that the public can't see. I don't know how that fits into the exaggeration part of this, other than just to be careful when something's losing its value, that it could be because of insiders and moving things around that you and I can't see, and so just generally be careful. But I think that's that point. And then we have exaggerations. Mostly, he says they come from speculating gamblers, and analysts should stay away from that game. So that's that. Then we have a section on litigation, lawsuits that can cause undervaluation, especially in senior securities. But he has he goes through a bunch of examples here. The first one of the government demanding that a company splits. That happens still today. Normally, that would be a bullish situation, apparently, he says in here, but any litigation, whenever there's news that, the government's like trying to force this company to do something, it scares the market, and then the price drops for basically oftentimes no reason at all, or it drops more than it should drop. So, for example, even if they were to settle, and pay the full amount of the lawsuit, the price got so low that, there's still like intrinsic value to be had between those numbers. And I think that's one of those cases where I think like today would be especially hard to find good cases of. But I mean, I don't know. Maybe there are cases. I mean, the Activision one comes to mind. How that was an arbitration play that people got scared off by. I think it was a British lawsuit or something trying to block Microsoft from buying Activision, and it drove the share price down. But they acquired it anyway, I believe, at the price they said they were going to. But that was a very interesting situation, and actually Warren Buffett, they took advantage of that. They took that as an arbitration play. So that's a real world, more recent example of this. And so he goes through more examples. So he has a hypothetical example of receivership, which means bankruptcy, obviously, where the bonds were selling at 50. Just a hypothetical example. How a small lawsuit, unlikely to succeed, is put on the company. Says, hey, we need, let's say, $10 of each one of those bonds, but then it drops to 35 instead of 40. He doesn't use those numbers, but he says, it drops too much, basically. And then we go through real examples of that happening, various examples, some bigger than others. One of them is sort of just a small discount, and then other ones are like huge discounts. And I'll skip to the last arbitration play he mentions here, where the bonds were selling at 4, and they later got a liquidating dividend of 12.5 and 2, so 14.5 for 4. So if you had bought those bonds when they were selling for $4, you would have multiplied your investment by 3.5 in a pretty short time. Sounds like. So anyway, all of those, there's a bunch of examples there of plays. It's good reading through those and trying to understand them, so that I especially just in case somehow you run into something like this for yourself in the future, obviously. So then we have a section stating how the lowest level of bond prices is typically right before a reorganization is announced. And so, when bonds are extremely cheap, it's a sign that the market thinks that they're going to go bankrupt, right? And then, something has to happen. It's like they either need to somehow recapitalize by selling more stock, which he talks about companies doing, and making them more safe, because they basically bought themselves a pillow, and for a one-time situation, and they're going to be fine after that. That's a situation you can take advantage of. But moving on, he mentions how the time factor is a subordinate consideration in security analysis, citing that how, this process of finding super cheap bonds that are likely to result in essentially an arbitration play can take several months or longer. So, my takeaway from that is a little bit of patience is involved and necessary. And it took patience for the Activision for that to play out. It's funny. It's very funny the history when they announced when Microsoft announced they were going to buy it, it like shot up, but not like to the full price, and then it waffled around, and there was a lawsuit, it went down, and it went away, it went back up. It was like it was a roller coaster, but it took a long time. So that pays tribute to that idea there. So, and then we have a last section of this chapter about railroad trusteeship. Very interesting. 1932. This was like the beginning of the Depression. How 31% of mileage, and I believe that means the actual ownership of the rails of the roads. He calls them roads. He calls them mileage. He's talking about railroad tracks. 31% of all of the mileage was in the hands of receivers or trustees, which was very interesting. And then we have last main point. That could have been a really great opportunity for people to buy stuff at a big discount. However, the earnings kept dropping, and so it didn't necessarily play out. And that again pays tribute to making sure that the qualitative data helps your situation and doesn't hurt your situation when the quantitative data is looking peachy. And that's all we have for chapter 50. Hope you enjoyed. Rob's Child.